Hi, how are you? Say I'm fine. Tell Tabitha. Hi, Tabitha. Tell Tabitha. Hi. Hi. We were scheduled to start at 8. We are just about to start. Kirsten, don't do that, please. Kirsten says hi. Can you hear me? Please let me know if you can hear me. As we wait for others to join, my name is Belin. In this session, we are going to be discussing about today's good evening. Thank you. You're welcome. In today's session, we are going to be discussing about today the Treasury Bonds which were issued last month. They will be on auction this month on 9th. Yes, Kirsten? You want to say hi? Okay, say hi. Kirsten wants to say hi. Hi. Hi, Matano. Thank you. Now, we are going to be discussing, bye, Kirsten. We are going to be, sorry, I am a mother. We are going to be discussing today the auctions, the Treasury Bonds which are on auction. The auction will be happening on 9th of October. And like I told you before, bonds are auctioned every month. So CBK has reopened two papers, and we are going to be going through those two papers in comparison to the Treasury bills so that we can understand which of these three investment vehicles will be best for you or it will be best for your scenario at this particular instance. My name is Belin. Please let me know if you can hear me. You can also be dropping me questions or leaving me your comments in the comment section. I have a different phone which I'll be using to go through your comments or to see your queries if you have any. Now, we are going to go straight to the point. CBK has reopened two Treasury bonds. We have FXD1 2016-10 and FXD1 2022-10. Now, to illustrate or to explain the naming of those bonds, FXD1 2016-10, 2016 refers to the first year when it was opened or when it was auctioned, when it was first issued. And the last digit, stroke 10, refers to the first time when it was issued. How long was that tenor? So the FXD1 2016 tenor was first issued in 2016 and it was a 10-year paper. It was meant to run for 10 years. The second paper, FXD1 2022-10 also, was first issued in 2022, the year 2022, and those years are important. I'm going to tell you why the years are important, yeah? And since it's a stroke 10, it means that it was first issued to have a maturity of 10 years. So when a paper has been reopened, when a treasury bond has been reopened, even for the corporate bonds, by the way, the terms and conditions of the reopened paper remain the same as to when it was first issued. These terms are things like coupon rate, the tax rate, the coupon payment dates, and the maturity date. Of course, because the tenor also remains the same. Yeah? So now the FXD1 2016-10, the first time it was issued back in 2016, it carried with it a coupon rate of 15%. So even right now that it has been reopened, it's also carrying with it a coupon rate, the same coupon rate of 15%. All right? And the tax rate back then was 10%. So the tax rate right now remains the same, 10%. Remember, treasury bonds are taxed. They carry with them a tax rate. The ones which are the long-term papers, like the 10 years and beyond, are taxed at 10%, and the shorter ones, the 2 years, 3 years papers, are taxed at 15%. This is to compensate you. The lower tax rate for the long-term papers is to compensate you for the duration, the longer, for allowing the government to hold your money longer. in layman's language. Now, the papers which are the FXB1 2016-10, since it was issued back in 2016, it now has 1.8 years to maturity. Yet, it's still being taxed at 10%. Now, if this was a new issue, if this paper was being auctioned right now with a 1.8 years, if it was a 2-year paper, which is a new auction, not a reopened paper, which is a new auction, it would have been taxed at 15%. Why? Because it's a short-term paper. But since they are being reopened, it's being reopened, that is why it's carrying with it a 10% tax, which is shorter. So this is an advantage to you. It's an advantage to me as an investor, as a retail investor for that matter. So why would you choose? We have the we have the 2016 paper, which is taxed at 15%. It has 1.8 months to maturity, 1.8 years to maturity, sorry. We also have the 2022 paper, which is a 13% coupon. It's carrying a 13% coupon, 13.049, I think. And it has about 7.6 years to maturity. Okay? And then, every week, now apart from the Treasury Bonds, every week CBK issues Treasury Bills. They auction Treasury Bills. These are investment vehicles. They are short term. We have the 3 months, we have 6 months, and we have 1 year. So every week, CBK auctions Treasury Bills. And the Treasury bill for this week, for last week, the results were 16.7 something percent, yeah? So as you can see, the Treasury bill has a higher return compared to the 2016 paper, which is 1.8 months. It has 15%. And then we have the 2022 paper, which is carrying with it a coupon rate of 13%. So presented with these 3 investment vehicles, which one will be ideal for you? Which one would you want to go for? I'll give you my scenarios under which I'll be picking any of these 3. I'll give you different scenarios which will make me want to go for any of those 3. But as an investor, for you as an individual who is watching, which one of these 3 investment opportunities would you be going for if money was not a problem? If you had 1 million or if you had 500,000 shillings, which of these 3 would you rather go for? The FXD, the Treasury bill, the 1-year Treasury bill, which is earning you 16.7%, it is taxed at 15%, or the 1.8 year, the 2016 rather, Treasury bond, which is earning 15% and is taxed at 10%, or would you rather go for the 2022 Treasury bond, which has a coupon rate of 13% and is taxed at 10%? Presented with these 3 investment opportunities, which one would you rather go for? Now, personally, because I'm looking towards accumulating passive income, I'm looking towards having passive income, as in having some constant and consistent flow of passive income. And given that the current inflation rate is 3.6%, the current inflation rate is 3.6%, presented with 13%, I will pick that paper. I will pick that 13% coupon. That is the 2022 coupon. Why? Because I'll be guaranteed of constant cash flows for the next almost 8 years. My aim is to have a monthly cash flow of money that I'm receiving, and I'm not having to wake up very early in the morning to go looking for that money without my time being tied up. I'm looking forward towards a situation where my money will be earning me money. I'm looking towards a situation where I could call myself a millionaire. Why? Because I have accumulated sufficient passive income. or I have accumulated wealth so much such that my net assets are exceeding my liabilities. My net assets are exceeding my loans, being my liabilities. Now, for me to attain that goal, for me to attain that investment goal, I will need to be thinking long term. And I will only be able to do that if I have my short-term needs catered for. My short-term needs being my emergency funds, of course, and my the expenses I will have to be incurring in the foreseeable future. Like school fees is catered for, my car loan is catered for. Those two short-term expenses are catered for. But most important or most critical is my emergency funds catered for. Now, because that is my investment objective, accumulating wealth, being a millionaire in the near future, the long-term paper is ideal for me. It might not be ideal for everybody else. I don't mind tying up the whatever little money that I have now for that duration of time. However, if you are holding monies that you want to be using in the next few years, in the next 2 or 3 years, you'll like to have access to them, then the 2022 paper might not be ideal for you. I'd like to go through the comments. I prefer the just like me, I prefer the long-term 10-year, reason being it is offering me coupons on the same date as other bonds. Secondly, being long, yeah, we seem to be having the same objective. That makes a lot of sense. I'm curious to know, presented with these 3 papers, which one would you go for? Now, another reason why you'll be going for the long-term paper, even though it's offering you 13% coupon, is because I want to bring in a concept, so I need your concentration. We have the primary markets and we have the secondary markets. The primary markets is where you buy papers when they are on auction. You buy the bond directly from CBK. The secondary markets, Dennis Mushiri says 10-year coupon. Now, we have 2 10-year coupon papers. We have the 2022 Treasury Bond, which was a 10-year paper. We also have the 2016 Treasury Bond, which is also a 10-year paper. So presented with these 2, they are both 10-year papers. We have a 2022. It has a coupon rate of 13%, but has a 7 point something years to maturity. We also have the 2016, also a 10-year paper. It carries with it a coupon rate of 15%. Tax rate is the same for both of them. Which of these 2 will you be going for? Now, I was telling you another reason why the 13% coupon paper will be ideal for me is because when you're buying bonds, we have 2 markets. We have the primary market, which means that you are buying the paper. You are making your payment to the issuer. The issuer for treasury bonds in this case is CBK. So you can either buy these papers from CBK directly, or you can buy it from other people, from Abelin who had bought it back in 2016 and now is hard pressed for money and wants to have some money now. What do? I'll go to the NSC, which is now the secondary market, and sell off my investment. Now, when you go to buy this from the secondary market, you can either buy it at a discount, meaning that you'll buy it at a lower price. Oh, I see. You'll buy it at a lower price. You'll buy it at a lower price than buying at a discount. Means that you'll buy your actual investment amount will be lower. If you are buying a face value of 1 million, if you want to invest 1 million, so that you be receiving coupons on your 1 million worth of investment. If you have to buy at a discount, if you are buying at a discount, you'll have to be paying maybe 900,000 or 900 plus or 800,000 shillings. Now that means that you're buying at a discount. Now, when you go to the secondary market, I've told you that T-bill right now is at 16.8%, and we have a 13% coupon paper which has been floated, right? So now, what will entice me to take this 13% coupon, yet I have an opportunity at the same time to earn 16.7% from the market right now, being the 1-year Treasury bill. To entice me to take this 13% and not the 16%, this 13% will be sold at a discount. Remember, in the market, we also have the IFBs, the one which was auctioned at 17%. Of course, that will be more attractive. Remember, it's also paying coupons in I think in May and November. I can't exactly remember the coupon months. But that IFB of 18% or 17% will be a better investment opportunity for me or for you as opposed to the 13%. So what will make me want to buy this 13% coupon? It will have to be sold to me at a discount to make it more enticing for me, okay? Otherwise, all investors will be going for the IFBs, which has no tax, and they are being sold at 17 or 18%. Now, by the mere virtue of the fact that I expect to be buying this 2016 paper or the 2022 paper at a discount, I foresee making a capital gain. A capital gain is the difference between the amount which CBK will be paying me back and the amount which I'm investing now. Okay? So that will entice me also to go for the 2022 paper, which has a coupon rate of 13%. This coupon rate of 13%, which is lower than the market rate, is going to expose me to possibilities of earning some capital gain. Now, if I put a bid of 100,000 on this paper, CBK will ask me to pay maybe 80-something thousand on that paper plus interest accrued, but they will be paying me coupons on 100,000, my bid amount. So that is also one thing that would make me want to be going for the 2022 bond, which has a coupon rate of 13%. However, if I was in need of the money, in the next near future, in 1 year or 2 years, then that bond will not suit my investment goals. So if you want to make a choice, on the investment, on the paper to pick, the Treasury bill, the 2022 paper, or the 2016 paper, you need to align it with your investment goals. All right? I'm trying to have a look at your comments. Let me know if you have any question. I'm trying to... All right, now I should be able to comments. Anyone with a question, let me know which of these 3 papers would you be taking. Yeah, now I can see your comments. Which of these 3 papers will you be taking? Gitobi is asking, kindly share contacts of secondary market or who to engage in. If you want to buy a treasury bond from the secondary market, you'll need to have a broker. Your bank is an investment broker. You can go to StanChart, Equity, Family Bank, SBM Bank. Basically, all the banks are investment brokers. All right, you can have a look at them. You can also be look at other, like your stockbrokers are brokers as well. Old Mutual, is it AIB, AIB Capital, NCBA, all those all those stockbrokers are investment brokers. Murigi, is that what you needed to ask? I mean, is that the kind of answer you're expecting? Does that answer your question? Sorry. Murigi, does that answer your question? That's what I meant to ask you. Oh, thank you. Anybody else with a question? Thank you, Guni. Kiplasma, thank you, and Karibu. Kiplasma is saying, I prefer the long-term 10-year. Reason being, it's offering me coupons on the same date as other bonds, other bonds. Secondly, being long time, I have more opportunities to gather the coupons and continue to reinvest. Yes, you also have opportunities to compound the coupons, to reinvest the coupons and to compound and to maximize and enjoy the power of compounding. Someone is asking, does the choice of a broker matter? Certainly. The choice of a broker matters because, of course, there's customer service, number one. Number two, commission. Let me mention this. When you're investing through a broker, of course, they are using their expertise, they're using their time. They are going to charge you commission. And this commission varies from one broker to another broker. Now, some brokers also have a digital platform. Others, you have to literally go there kiguna njia. So yes, a choice of a broker matters. You need convenience. You want to be sold for convenience. And you also don't want all your return on investment to reduce because of the brokerage charges. So yes, the choice of a broker matters. Look out for the fees, look out for the customer service, look out for the digital platform. The world is digital. You don't have to be walking into your bank for you to be able to transact, all right? Ajambo, does that answer your question? Anybody else with a question? Today's session is going to be short because I've already done 2 videos analyzing these 2 treasury bonds, but just for the benefit of those who are joining now, thank you, Ajimbo. For the benefit of those who are joining now, these papers will be auctioned on 9th of this month, 9th of October. Auction means that that is the day that CBK will be making a decision on the coupon rates, on the bonds to accept, on the bids to accept, and the ones to decline. So if you ever want to put a bid for this paper, you would have to bid or place your bid by 9th of this month, that is next week, by 10 a.m. If you try bidding and by 11 a.m. you'll be late, utakuwa ushachelewa. So kama unataka kuinvest kwa hizi bonds, weka bid yako by 10 a.m. I feel good I spoke in Kiswahili. Any other question? Okay, if we don't have another question, I'm going to have to end it at that. I have done 2 videos reviewing the 2 papers. Any other question that you may be having, I'll be happy to take it. Does not necessarily have to be on that these 2 papers which are on auction, about bonds or about bills, treasury bills. Dennis, you want my contact? I'll put it down in the description box, or I'll leave it in the comment section. Yes, I'll plan for shares. We'll do a live on shares. I'll plan for that. Thank you for that. We could do it on the next session will be on shares. Thank you, Little Smart. Any other question or comment that you'd like us to discuss now with regards to bonds? Kindly, just a quick explainer on why you believe interest rates are going down. Good question. Now, interest rates are affected by different factors. Interest rates are affected by different factors. We know that one of the factors, I'm trying to simplify this as much as possible. One of the factors is we have an economy, Kenya. We also have other economies. Kenya trades with different economies. Part of these economies is the US. We know that the dollar is a legal tender here, okay? The euro is a legal tender in Kenya. We can pay and exchange in euros and dollars, okay? Even though our legal tender here locally is Kenya shillings. But there are certain services that you can pay for in dollars. When we export, we are paid in dollars. When we import, we are equally paid in we equally pay in dollars. So the dollar kind of has an impact in our economy. The central bank for US, called the Federal Reserve for US, yeah, the US Central Bank, equivalent of our CBK, recently had a reduction in their interest rates. All right? During COVID time, they had this reduction in interest rates, which was meant to manage the economy. Now, right now, to manage the quote-unquote recession, they had a 50 basis points reduction in their interest rates. That is equivalent to 0.5% reduction. Now, when that happens, it affects their economy. It affects the US economy. How does it affect the economy? It means that those who are buying the US Treasury bonds, those bonds will become non-lucrative for them. So what happens when they have money to invest and they cannot invest in their bonds anymore, or they don't want to invest in their bonds anymore because their the return on their bonds in the US economy has become less attractive for them? Two things will happen. They'll either divert this amount they would have wanted to invest in their bonds to their shares. So their shares, the stocks in US is expected to increase. All right? Now, the other option that the investors in US have is to look for other markets. These other markets can be India, can be Europe, can be in Africa. And in Africa, Kenya being in Africa, we present to them a good market. So we expect, there is an expectation that even the Kenyans in US will want to now send money back home to Kenya to invest in our government securities. Why? Because we still have higher interest. Our T-bills offering 16%, almost 17%, yet their interest has come down. Now, when the foreign investors remit in monies to Kenya to invest in our government securities because our rates are still higher, CBK will be seeing an oversupply of demand in the papers they are auctioning. Now, when that happens, for instance, when now in these papers, if they were to be oversubscribed, CBK will have the confidence now to reject the competitive bids or the competitive bidders. Let me know if I'm clear. The competitive bidders who had placed their bids with expecting high coupons. So when the high coupon competitive bidders are rejected, it means that the average of the accepted bids are going to be lower, and non-competitive bids are paid coupons at the average of the accepted competitive bidders. Okay? Now, if we had people who are putting their bids at 23%, 25%, 18%, and CBK is able to achieve this 30 billion they were looking for from bidders who are bidding at 18%, 17%, it means that when the other high bids are rejected and they accept the lower bidders, the competitive bidders who put in lower bids, the average of that accepted bid is going to be lower. So by default, the rates are going to come down. Okay? So that is why I foresee the rates coming down. At the same time, even CBK here, we also have a monetary policy. They had also recently reduced their local rates. So by all means, all factors are pointing towards a reduction in interest rates. Okay? Now, that is also one of the reasons why I would find the 2022 coupon or the 2022 Treasury bond attractive for me, because I'll be able to lock in this 13% for a longer duration of time before the rates come down to 10% or to 12%. Does that answer your question, T-Plasma? And now, as I wait for other questions, Dennis is asking, do we expect more bonds to reopen? Do we expect more bonds to reopen come next 2 months? Yes, I personally expect CBK to reopen more bonds. Why? When they reopen bonds, they are kind of dictating the rates, the coupon rates. They are dictating the coupon rates. Now, when bonds are reopened, they are reopened with the same terms and conditions. They are reopened with the same terms on which they had initially been issued at. So when there's a new issue, remember, there's been a tug of war between CBK and investors, the competitive investors, the institutional investors, specifically banks, money market funds, your pension funds, your church, some of these schools, the circles. They have been demanding for high rates, and I think that's the reason why CBK has taken longer to auction IFBs. CBK, on the other hand, to manage inflation in the economy, or to manage to stabilize the economy, the CBK has been pushing for low rates. Remember, when CBK auctions at higher rates, at higher coupons, the burden of paying these high coupons goes back to the government. Now, to manage that, CBK has been working towards pushing rates down, and competitive investors have been working towards having higher returns. They keep putting high bids and high bids. If you look at the previous auctions, the results for the previous auctions, you'll notice that there was a lot of rejected bids, even though CBK did not meet their target. Even in this auction, we are going to have rejected bids, even though the bids might likely not hit the 30 billion that CBK is asking for. The question is, are we expecting more bids to be, are we expecting more papers to be reopened? And I was telling you, yes, they are going to be reopened, because that is one way of CBK controlling the interest rates. All right? And just to mention, treasury bonds are auctioned every month. So every month there's always going to be an auction. It can either be new or it can be reopened. But I expect CBK to continue reopening the previous auctions, especially the ones which has low coupon rates. Any other question? Very well. Oh, Becky, thank you. Anyone else with a question? Dennis, does that answer your question? Yes, I expect more papers to be reopened. Most likely the low coupon ones, because we're expecting rates to come down. Rebecca is asking, what does it mean when fund managers invest in a fixed fund and when they invest in bonds? Which one provides better returns? Bonds are fixed funds. Bonds are fixed funds. So the return is the same. Another fixed fund is fixed deposits. Fixed deposits in commercial banks. So fixed funds is just bonds. Remember, bonds and fixed income securities. It's not the same thing. I'm not sure if you meant to ask MMFs and fixed funds, Rebecca. Isaac is saying thanks for the detailed and insightful info. Thank you so much, Isaac. Appreciate it. Dennis, I'm glad you answered. Rebecca, did you mean to ask investment in MMF and fixed income securities because they are both unit trusts? Is that what you meant to ask? MMF and fixed funds, correct. Thank you. Now, MMF is money market funds. MMF is full for money market funds. Money market funds are short-term investments, yeah? Investment vehicles, like the fixed deposits, we have the treasury bills, we have the commercial papers. Fixed funds are investments in the long-term fixed income securities. This still includes fixed deposits. It has treasury bonds. It has corporate bonds. Now, because of the element of corporate bonds are long-term corporate papers. Corporate papers is like commercial paper is like a treasury bill, and corporate bond is now like the treasury bonds. Only that now one is the corporate and the other one is now the government, CBK. Now, when they invest in the MMF, they invest in highly secure but short-term papers. Okay? When they invest in the fixed fund, also called the bond fund, then they invest largely in the treasury bonds and the corporate bonds. Okay? Now, the element of investment in treasury bonds makes that fund a little bit riskier, and the returns in the investment in the fixed income securities normally tend to be slightly lower than the investment in the MMFs, because the MMFs capitalize mostly on the treasury bills, and they also capitalize on the investments in banks, fixed deposits, and they have the advantage of negotiating for higher returns. Now, the MMF are rated as very low risk, and the fixed income or the bond funds are rated as medium to low risk. Low risk, but medium also. Okay? I think it's because of the element of investment in corporate bonds. There are certain fund managers which had invested in certain corporate bonds, and those bonds, the bond issuers were mismanaged, And so the depositors or the investors' monies were exposed to those risks. That is why the fixed income is classified as low to medium risk. I told I'm a mother. This is part of me being a mother also. Anybody else with a question? But this is cold case. You have to drink cold yogurt. But it's almost over. Okay. Anybody else with a question? Talk briefly about September 2024 inflation according to CBK. Dennis, tulikuwa tunaongelelea bond, but now that you ask, and how they affect interest rates for bonds. Oh, that's a good question. That's a good question. Now, inflation is the change in commodity prices, different prices, food, oil, what other things do we buy? Services, what else do we buy? Mashakura, clothes. What else do we buy? Now, inflation is the difference, books, stationery, everything, all those things that we buy when we walk into the supermarket and buy soaps, kila kitu, houses, yeah. Hey, Becky, lakini houses, that is a long-term thing. Houses haitumiki kwa nini? Houses haitumiki kwa inflation. The short-term, the short-term things that we buy. Inflation is something that it's normally the fast-moving goods, medication, food, different foodstuffs, of course, sabuni, and all those things. Now, inflation measures the difference in their prices. When there's when there's an increase in prices, when there's a huge increase in price, we say that there's an inflation rate is higher. When there's a reduction in prices, we say there's a reduction in inflation. Inflation has reduced. Okay? We say that inflation has reduced. I'm looking at your comments. You keep the questions coming in. So now, for CBK to know the current inflation rate, they will take they'll check the price changes in different commodities. Of course, in different sectors, different commodities. And then the average or the wholesome change of prices in those different commodities in the economy is what now will be determining the inflation rate. So talk briefly about September 2024 inflation according to CBK. Yeah. So now that is how CBK determines or goes through. That's how the CBK determines the inflation rate for the country. For this month, it had reduced to 3.6%, meaning that there has been a small change or a small reduction in commodity prices, even though the prices for food has increased. When you look at that inflation that CBK had shared, you'll see the food prices is in red. The food prices is in red, but the prices for other things are in blue. Meaning we had a reduction in other prices, even though the food prices has had an increase. Let me have a look at it and share with you. Yeah, the food prices were at an increase of 5.1%. Non-fuel had an increase of 1.1%, but kerosene reduced by 21%, diesel reduced by 14%, petrol reduced by 10%, electricity reduced by 10%. My bill reduced from 7 to 5,000. So that's inflation right there, yeah? A reduction in inflation. Sugar reported a reduction by 29%, maize a reduction by 19%, wheat had a reduction of 10%, cabbages increased, potatoes increased, onion increased, and of course there are other food items which they also look at. This is just but a summary of whatever they had reported. Wilson says inflation reduced from 4.5% to 3.6%. Yes, that is true. The net overall effect on the changes in prices was a reduction by 3.6%, which is a good thing for the economy, by the way. So how do we relate inflation? Oh, I was forgetting. Kama hauja subscribe, please press the subscribe button tafadhali. And to those who subscribe, thank you so much for elevating this channel. Yeah, this is our channel. So how do we relate inflation to interest rates? What's the relationship between interest rates and inflation? What's the relationship between interest rates and inflation? When the bond rates are at a specific level, let's start them off at 18%. Now, I know that the paper on auction now is 13%. Huh? Now, what would happen if CBK was to reopen the Treasury bond or the IFB, which was at 18%? The fixed deposits right now is roughly at 15% or 14%. If CBK was to reopen a paper which was at 18%, what will happen? I will want to remove my fixed deposit from the bank, which was paying me 15% or paying me 13%, and pump it into the Treasury bond, which is earning 18%. Now, when that happens, my bank or your bank will want to retain your money with it. So your bank will increase its deposit rate. Your bank will offer you a higher rate than the 10% that is paying you now. Why? To attract you back from going to the government, from taking your money to the Treasury bill, or from taking your money to the Treasury bond. So what happens is that to attract you back to the bank, your bank will increase the deposit rate. And who will bear that increase? Or how will the bank pay you that increase in interest rates from the loans? So the bank will increase the lending rate. Why? Because all banks are in the business of buying money, the deposits, and selling money, the loans. So because the buying price of the bank's money has increased, their deposit rate has increased, the bank will be selling these loans at a higher rate, meaning the interest rates for the loans is going to go higher. And what happens when the rates go higher? We are explaining inflation. What happens when the rates go higher? Borrowing for you as a business person or for me as an individual becomes more difficult. Okay? When we move from a state where I was borrowing a loan at 13%, and now my interest rate has increased to 18%. Two things will happen. One, my installment rate is going to increase. And when the installment rate increases, it means that my buying power, my purchasing power will reduce. Assuming a net income of 50,000 shillings for my household, and my installment rate has increased, it means that I'm going to have to reduce my disposable income from 50,000 to say 48,000 or even 45,000 shillings. Why? Because I have a higher loan rate to pay. All right? When my disposable income reduces, that means that I'm going to cut down on my expenses, on my expenditures. If I was going for holidays, that now becomes a luxury. If I was eating chicken maybe 4 times in a week, I'll have to reduce that to maybe 2 times a week. If I was taking yogurt, like someone is taking yogurt now, if I was taking yogurt every day, I'm going to have to reduce that because I have less money at my disposal to spend. Why? Because I'm having to pay the bank more money. Why? Because the bank increased my interest rate for the loan. So my installment has increased. Why did that happen? Because CBK had increased their coupon rate. And so to attract clients from going to the bank, from investing in CBK and retain these monies in the bank had to make those adjustments. So this is how it affects me individually. Now, my purchasing power has been reduced. So when my purchasing power has reduced, it means that when I walk into the supermarket, if I would go to the supermarket and buy 2 loaves of bread, now I'll have to cut that down and buy just 1 loaf of bread. So what impact will that have to the manufacturer of this bread or to the baker of the bread when all of us are going through this experience? When all of us are going through this experience, the fact is that the manufacturers would have to scale down their production. Why? Because no one is buying these breads anymore, or everybody else have reduced their consumption. Okay, so when the buying prices have been, when the buying quantities have been reduced, it ultimately eats into the inflation. They are going to reduce less because of the reduction in the demand. And we know when there's a reduction in demand, the suppliers, there seems to be a burning question here. Yeah, I'll get to those are similar names. That's a name I can't pronounce. Wealth Sense is saying. Yeah, so that is ideally how interest rates and inflation are related. Grace is saying, thanks for refreshing my memory. You always have to keep yourself informed. You're welcome, Grace. Anybody else with a question? Did that answer your question? Who had asked that question? Mushiri Dennis, did that answer your question? Wilson is saying inflation is a composite variable with a direct correlation in cost of capital, interest. A reduction leads to reduction. Yeah, that's exactly what we have explained. A reduction leads to reduction in interest, but there are other factors that may erode the positive effect. Okay. Anybody else with a question or with a comment? Anybody else with a question or a comment? Grace, what has... Thank you for refreshing my memory. I don't know, I find that interesting, but you're most welcome. Anybody else with a comment or a question? Rebecca is saying thank you. Little Smart has said, Mushiri had a suggestion. Hi, are you able to do a live on shares someday? Yeah, the next session will be on shares. We will be discussing shares investments. Thank you, Mushiri. We'll be discussing shares next time. The next live session will be about shares. Ajambo, thank you. I hope by the end of this year, we'll all be having a CSD accounts. Anybody else with a question or a comment? Or we can end it there. But before ending, I would like to thank you so much for joining the live session. Thank you for the question. Thank you for the comments. If you haven't subscribed, please press the subscribe button. And thank you so much for pushing me to 1,000 subscribers. This is your channel. Thank you. Thank you so much. I appreciate. I lack words. I don't know how to say thank you. I lack superlatives rather. Thank you so much. Anybody else with a question or a comment? Anybody else with a comment? I want to give you guys a homework. Tell me what you understand by redemption structure. Tell me what you understand by redemption structure. You can type that in the comment section. What do you understand by redemption structure? Number one. Number two, assuming you are presented with the 500,000 shillings, oh, thank you, Becky. That's very kind of you. Becky is saying your concepts are consumable for those of us who just got started in this investment journey. Thank you so much. I'm happy to know that I'm making an impact. Highly appreciate. Now, tell me in the comment section, we are still on Treasury Bonds, what you understand by redemption structure. Number one. Second question, if you are to invest in this bond now, do you have to wait until the maturity for you to access your money? For these bonds which have been issued now, and how does this bond, these issued bonds, the bonds on auction, how do they differ? How does these bonds differ from IFB? Mushiri, just try. I just need to appreciate, or I just need to know that whatever knowledge I'm sharing is making some impact. Just try. In Lua would have said just gaja gaja. I mean, just mix them together. Just mix and match the words together, we'll understand. If you are to invest in these papers now, if you are to buy these bonds which are on auction, do you have to wait until maturity for you to access their money, your money rather? Kiplasma is saying redemption structure refers to how the initial principal will be paid back over the life of the bond. Most FXDs have one redemption date, while some IFBs are amortized. That is 100% correct. That is the redemption structure. To redeem, just like in Christianity, to redeem redemption is getting back. When we say we have been redeemed by Christ, Christ has saved us. Yeah, that is the essence of redemption. Even with bonds, or in loans, to redeem means to pay back. So with bonds, with the same breath, to redeem means to receive back your principal. Not your principal per se, but the first value of your investment amount, yeah? So like Kiplasma says, redemption structure refers to how the initial principal will be paid back. On which date will you be receiving back your investments or your principal? Yeah, that's right. So now that these papers on auction, now that the prospectors are not having a redemption structure, Does it mean that if I buy the FXB1 2022 10, I will be receiving back my money in 2032 because it's a 10-year paper and it's not having a redemption structure? Does it mean that if I invest in this paper, I will only receive back my investment in the year 2032? Kid Plasma says bonds can be sold. Bonds can be sold before maturity. One does not have to hold till maturity, but it's usually wise to hold it till maturity. Yes, that is 100% correct. You can, this is where the secondary market comes in. You can sell it in the secondary market and receive back your money. So bonds are, I call them semi-liquid. They are not liquid because you can't wake up now and receive your money today, yet they are liquid because you can receive your money today. It's just that the process of receiving back your money is a bit cumbersome and it predisposes you to losses, especially if you have a low coupon paper. Ajambo is saying, please mkijibu msitumie jargon mnatu confuse. No, in this channel we don't use jargons. We simplify it as much as possible, because the intention is to get this information outside there and to create financial literacy to everyone, including the grassroots level. I try to make my grandmother, who did not go to school, understand. World Sense is giving Kiss Plasma 8 out of 10, but I want to give Kiss Plasma 10 out of 10. He says, in addition, a redemption structure includes a tabulation of the coupon payouts. Are coupon redemptions? I think coupons are redemptions. Redemption means payback. Are coupon redemptions? What do you guys think? Are coupon redemptions? I think, yeah, whereas the prospectus has the coupon payment dates, coupon payments are not redemptions. Redemption is to recover, and you can only recover that which you had initially, which is the face value of your investment. So yeah, I will give Plasma 10 out of 10, not 8 out of 10. Anybody else with a question? Anybody else with a comment? Anything that you need clarity on, or anything that you want us to cover next time? Next time we have agreed that we'll be covering shares. Let me read that from here. Coupons are not redemptions as such. Actually, let me just say, coupons are not redemptions. Remove the as such. But in the case of amortized bonds, some portions of the principal plus interest is paid back over time. Yeah, that is true. In the case of amortized bonds, where we have redemption structure, In the Kenyan market specifically, IFBs have redemption structures. Some principal is paid back before maturity of that paper. And when that principal is paid back, it means that it will affect the coupon amount that you'll be receiving. The coupon rates remain the same. The coupon payment dates will also remain the same. If you had invested, say, for instance, 10 million, and you have a redemption structure of 50% within 5 years, 30% within 7 years, and the balance on maturity, and on year 5, you receive back your 50%, that is 5 million, you will continue from year 6 going forward. You'll now be receiving your coupons on the reduced amount of 5 million. I think that's what Key Plasma is saying, which is also very correct. So on that, I give you another 10 out of 10. Mushiri, coupon area terraced. Hiyo inamaanisha nini, my dear? Did you mean to say coupon payment period? Yes, thank you. Coupon rates are interest rates for beginners. Thank you for for coming to Ajimbo's rescue. Ajimbo, you need to stay on this channel so that these terms can now become familiar to you. Coupons are interest rates. Yeah, that's correct. Coupon and interest rates. And when I talk about face value, I'm referring to your actual bid amount. That's the face value. Bid amount, yeah? It might not necessarily be your investment amount. Why? Because if you are to buy the paper at a discount, your actual investment will be less than the amount that you have put a bid on, that the amount you are bidding for. So face value means your actual bid amount. It's also the figure that CBK will be paying you interest on. All right? Ajimbo, if there's any jargon that there is, just mention in the comment section, we'll break it down. Now, I think that should be it for the day. Allow me to once again thank you for being here with me. Thank you for the questions. Thank you for the comments. Thank you for engaging me. I look forward to being with you again. You have no idea how much I'm looking forward to these live sections. I'll see you on the next video, on the next live session. You are good students. Asanteni sana. Bushiri is asking, make it easier for beginners to understand the difference of redemption structure and amortization. Did you just call Wealth Sense a beginner? Anyways, now, thank you, Mushiri, for that. I want to do this using, I don't know if I can display. I want to display this. Redemption structure, like we have said, is when you redeem back your investment. When you receive back your investments. Your investment being the face value of your paper. Okay? Amortization. Oh, thank you. You're welcome, Job. Thank you so much. Amortization structure is what is amortization structure, by the way? I want to know interest payment structure. Mushiri, what is amortization structure? As far as bonds are concerned. Anybody who knows what amortization structure is as far as bonds are concerned? Isaac, what is amortization structure? Why do I think the same as the redemption structure? Mushiri? breathing. Okay, I'll assume you meant the dates for interest payments, yeah, or coupon payments. So redemption structure is when you receive back your actual investment, the amount you had bid for, your principal, okay? And then we have these different dates. Every 6 months, CBK, when you invest in a treasury bond, coupons or interest or profits, quote unquote, is paid every 6 months, yeah? So CBK will give you 2 dates. Will give you 2 sets of dates. There's the maturity date. There is those dates, I mean the payment dates. There's the maturity date, and then we also have the dates, the redemption dates. I mean the dates when your principal or your investment amount is paid back to you. Now, apart from that investment dates, apart from the dates when you get back your investment amounts, we also have the dates, the actual dates when you'll be receiving your coupons. Every 6 months, they pay coupons. So the prospectors will be having these dates. Other dates that the prospectors will be having will be the bid date or the auction date, as well as the settlement date, the date when you're supposed to be remitting your payment to CBK. Now, other dates will be the date when the paper will be open for trading in the secondary market. I think that's what Mishiri had intended to ask. The coupon payment dates and the redemption structure dates. Any other comments or clarification or addition? I think that will be it for now. Thank you so much once again. Thank you so much for joining. If you haven't subscribed, please press the subscribe button. But asanteni sana for making this channel worth it. This is your channel. It's our channel. I can't have it without you guys. Thank you so much. I highly appreciate. And let's meet on the next live. I'll share the link much earlier so you are able to plan much better. Asanteni sana. Anybody else with a question? If not, I'll be logging out within the next minute. Becky, thank you so much. Karibu. If we don't have another question, we can end that now. Okay.